بسم الله الرحمن الرحيم والصلاة والسلام على رسوله الكريم. السلام عليكم جميعا. Your Excellency, your honorable guests, on behalf of the College of Business and Al Faisal University, we welcome you to the 3rd International Corporate Governance Conference. In reality, it is the 6th Corporate Governance Conference. Some of the familiar faces, alhamdulillah, they have been with us for 6 years, and they have been always winning, and they move from better to the best as well. I am honored to have with us today the team of the Corporate Governance Center, which now you hear in the news about the Tawteen and Saudi and all of that. Alhamdulillah, our team is 100% Saudi. We have the executive director of Dr. Mashhoor Murad. Dr. Mashhoor, he has a PhD in economics from UCLA, the former CEO of Merrill Lynch, then held excellent positions in Bank Al Ahli. And now he is an assistant professor of finance in our College of Business, and also the executive director of the Corporate Governance Center. He also would work with him two excellent colleagues. We have Ustadha Lubna Al-Rajah. She's the manager of the Corporate Governance Center, and Ustadha Rada Al-Sheikh, and she has been with us in fact for 3 years, and she can tell you more about corporate governance than I can. And with that, I would like to call on you to thank them and welcome them also for the center here. They work very, very hard. And with that, we have an exciting program, and due, of course, to the circumstances, we could not really plan and organize a conference like the first one, which you recall, we had it in the Fairmont Hotel. There are certain circumstances which prohibited us from going that far. And this conference also is conducted on Zoom. As we speak to you, there are many others listening to us out there. You have the brochure here. If you don't have it, it may be in the bag you have over there. And very soon we'll introduce the executive director of the Corporate Governance Center to moderate the program and take it from there. But briefly here, as you look at the program, you will hear a presentation on the Corporate Governance Index and its rationale. Those who have been with us saw some of that logic, but we would like to show you exactly its rationale, and the most important thing, it's evidence-based. It's not like a survey, conducting a survey there, or an opinion of some sort, whether we like it or not. It's evidence-based, and based on the information we have from the companies and how they themselves speak about themselves and publish material to the public to see what they have. Then after that, we'll have 2 lectures. Will be back-to-back, offered by 2 very, very capable colleagues to the theme of the conference, which emphasizes the Audit Committee of the board. One of them is Mr. Muhammad Amin, and later on you'll hear more about Mr. Muhammad Amin. And then Mr. Saad Al-Azam, and also you'll hear more about him. Then will be a panel discussion where Dr. Mashhoor will be moderating that. We have one colleague is with us here, Badr Aswelin, and the others are on Zoom, and you will see them there, inshallah. And without further ado, I would like to welcome Dr. Mashhoor to the podium. It's all yours.
Assalamu alaikum. Welcome to the 3rd International Corporate Governance Conference. The theme of this year's conference is effective corporate governance and the independence of the Board Audit Committee. But we'll talk about that part later when we introduce the speakers. The first part of the conference, I'd like to give you a presentation on the Corporate Governance Index, which is based on the results of fiscal 2020 of last year. Because it's evidence-based, there's a lot of research that goes in. We have to wait, first of all, for the financial reports for the end of the year to come out, and that's really our starting process. So that's sort of one of the reasons, there's a little bit of a delay in bringing the results. But nonetheless, this year, because we've done it for several years now, we really have a lot of very good data, and we can see trends, and these trends are encouraging in many ways, as we'll see. So I'll just start in the beginning. I'm going to go briefly for our new guests who are not yet familiar with our methods and our model. We'll go over those first before we actually talk about the index and the details. Okay, I'm going to start with Vision 2030. Now, Vision 2030 is very appropriate and applicable for us. It really started the whole momentum by taking corporate governance very seriously at all levels, private sector, public sector. Governance is an important issue. The ambitious goals of Vision 2030 really require a lot of investment, and we need international partners for that. This really brings the agency problem, into full magnification, and that's really why we study corporate governance in business schools. It's because of the agency problem, which is one of the main topics that's discussed in finance and corporate finance literature. And the agency problem basically is, the separation of ownership and management. Now, of course, when the ownership is a lot further, when you have international ownership, then governance becomes even more important. We want to make sure that management doesn't pursue its own self-interest at the expense of the shareholders. So that's what really, started this as an academic field. It's also discussed in law schools because there's a lot of litigation that's involved. So you see a duality from the academic perspective in addressing corporate governance in both business schools and in law schools. But this momentum really was bought in. It's bought in obviously by the regulators, but also by the companies. We're going to see as we go into the slide that there's been every year an improving trend across, the various categories that we measure in terms of best practices. So the momentum, the ambition, we all want to see it succeed, has really been the big driving force. And we've seen the regulators respond by upgrading their principles, their standards that they require. We as a third party are another set of eyes and analysts on these publicly listed companies that we can see and observe. And all of that just adds to the efficient market system. It contributes to it and gives investors an added degree of confidence. Okay, about us, well, the Corporate Governance Center of Al Faisal University, we're a not-for-profit entity. So we have an academic mission. We have a mission for training, consulting. We're independent, and we're a research organization. And so we play a very important role right now with the index, even though there's a lot of attention given to corporate governance. we really were able to benefit from spending a lot of time on the research aspect of developing the index, continuing to update and improve the model, and continuing to make these assessments and sharing it with the regulators and with those companies who want to learn more. We're always happy to engage them. Okay, and you know, we've really benefited from, you know, a lot of support also from the university administration and from the College of Business. So it's you know, a good working atmosphere, you know, as well. So we talked about research training, assessment. There's a lot of still, you know, services that we're, as we grow and build the organization, that we will continue to offer more services in the field of corporate governance. So we talked research, we talked training, executive education should be coming up for directors programs and familiarizing you know, executives with and board members with corporate governance and with best practices and their appropriateness for various different markets. And of course, you know, there's always a balance. A lot of corporate governance can become expensive, you know, so so again, you just really have to take really what's appropriate for you and for your size. So it's a balance to strike. But as we can see, I mean, there's, you know, definitely a lot of governance departments and a lot of the publicly listed companies, you know, separate from compliance. You see very important agencies, units that focus on governance. And so the attention is there and it's increasing. And now we'll talk about the index. Originally, the model was developed. You know, we didn't want to reinvent the wheel, so we worked with a company that has already had a governance rating model and a credit rating model as well. So you see the credit rating agencies, they oftentimes have also a governance rating as well. And we work with various also scholars and experts from you know, top academic institutions. Now we're going to get into the meat of the model. Okay, so the model relies on 4 different pillars. Okay, for governance, we assess companies, we look at their board of directors, we look at public disclosure and transparency, we look at shareholders' rights, and we look at stakeholders' rights. Now, as the model is right now, we have around 225 variables or different principles, we call them variables, but different principles that are spread across these 4 categories. Now, they're not equally weighted also, we'll get to that. Okay, so again, we look at when you look at wanting to adopt governance principles, obviously here in Saudi Arabia, we want to start with what is mandatory by the regulator. And in 2017, obviously we started our project earlier in 2015, but in 2017, the Capital Market Authority, the CMA, did a major upgrade to their governance regulations. And we incorporated that into our model. But in addition to that, we have additional principles and best practices that we thought were appropriate to add to our model from the OECD. Okay, just, for time, I'm going to over here. Okay, so the Corporate Governance Index is a way to assess companies in terms of their compliance to good governance principles for better decision-making, risk management, sustainable performance, and timely response to crises. So in a way, you want to have a system where if you have good corporate governance, if there is a problem, whether the problem is fraud or something else, you want to be able to catch it before it becomes an existential threat to your company. So you want to have something. I mean, there'll always be some problems that'll happen, but you want to be able to catch it early enough, not when it's just too late, and then there's no point of return. And it was an experience from other countries, like in the United States. Usually reforms in corporate governance come after some major scandals like the Enron and WorldCom. When that happened, it resulted in the Sarbanes-Oxley Act, which really established a big tone. Didn't come into effect until 2008, but it was I think voted 99 to 0 or something like that in the Senate to pass. But we're going to be discussing some aspects of that as we compare where we're at with various regulatory standards as it relates to the Audit Committee and other board committees, and like where the US and other countries are. Okay. So I'm just gonna move a little quickly from the history. Again, like Dr. Badges said in the introduction, even though this is the third International Corporate Governance Conference, it's the sixth conference that was produced by the Corporate Governance Center. So the first ones were maybe more domestic oriented, but this one we have international speakers and an international audience, as well. And hopefully after this pandemic, we were hoping it was going to be behind us. We're going to have a very large conference, kind of like what we had in the first one, where we're going to have actually papers presented with multiple sessions, and where we can have distinguished speakers come and fly in to present in person. Okay, now the model, of course, was developed in a very professional way. It really does cover a lot of. Yeah, maybe that. Okay. Yeah, it lends itself very well, to rating the listed companies from a governance perspective. And these are just some of the, processes that we used. It took a while to develop the model, and then even afterwards, in the first few years, we refined the variables. Actually, we had over 400, and we reduced them as we saw was appropriate. This is just some of the processes. We will make this presentation available on our website for those who want to have it. But it started, again, with a grant where the university competed with other universities and won the mandate from the Saudi Arabian General Investment Authority at the time. Now it's the Ministry of Investment. That's how the model started. Now we have a very good working relationship with the Capital Market Authority, and who value our work as we play a really important role in the market efficiency landscape. Again, just a little bit more of the background. Okay, now I'm going to talk a little bit more about the model. Now I mentioned the four categories. They're weighted differently. We give a 35% weight, okay, to the scores of the board of directors, a 30% weight to public disclosure and transparency, and a 25% weight to shareholders' rights, and only a 10% weight to stakeholders' rights. So this is definitely, while we do take stakeholders' rights, into account, it's weighted in favor of the shareholders as being, one of the most important stakeholders. But as the momentum of ESG continues to grow, the E and the S component, we have the S component covered in our model, is going to really take a lot more significance. And I'm going to point to some of those areas as we proceed in our model. And again, ESG and the stakeholder, this is all investor driven. It's all investor driven. So and a lot of academic research has been done, to really show that it's really in the interest of shareholders to give the due concern for other stakeholders, especially when sustainability becomes a very important criteria and measure. So this is just another chart showing the various weights of the categories. And again, the scale is going to be, this is very easy to understand. So once we talk about the index, we're going to have a score from 100 for each of the four categories. And then after they're weighted, we'll have a cumulative score, which is going to be the index for the year. And it's just like school grades. So an A is a score from, generally speaking, from 90 to 100. And so we'll see where we stand on this. Okay, now here, this is just to give you a little bit more information about our model and the variables. Now, our base model, which every single company on Tadawul is rated on, is 225 variables across the four categories. Now, the financial sector, which is comprised of the insurance companies and banks, they have additional regulatory regulations or variables that are imposed by the Saudi Central Bank. So in the case of banks, we have additional variables, and in the case of insurance companies, we have even more. And for that reason, you're going to see when we talk about the financial sector, usually we separate banking and insurance and talk about them separately oftentimes. Of course, all the other sectors combined are in the non-financial sector. Okay. And if you're not familiar with the OECD, okay, well, the OECD has really done a very large and exhaustive research and assessment of all of the practices in different countries across the world. And all of their regulations. And so they put it together in one place. And without really making a judgment, but you can see, where developed countries, where they are, various emerging countries, where they are, what they've adopted. And they understand, and as we all understand, that every country has its own experiences at the pace that they want to upgrade and improve. To create a solid foundation, because you want to have a culture of good governance, as well. We really don't want it to be just a compliance-driven, initiative, but we really want it to be really a little bit more of a values-based and more voluntary compliance. Our effort, not really compliance effort, in order to, improve the sustainability of the, company and the outcomes for all stakeholders. And this is just a sample of what we do when we come to scoring. So here's a question I can read. The majority of the board members shall be of non-executive directors. So this is a board of director question. So we look at the board of directors report, and we see who's independent, who's non-executive, who's executive. And so this is a CMA mandatory requirement. Because it's mandatory, we give only a score of half a point instead of a full point for compliance with this. If it was a guiding principle, we reward them a little bit more with a 1 point, and so forth. So this is just an example of the many different variables. This is one of the 225 variables here. Another board question, a board member shall not be a member of the board of directors of more than 5 listed joint stock companies at the same time. Again, when we teach, governance, we talk about busy directors. And it's a study, like that. And usually 3 or more in the US is considered a busy director, okay? 5 is acceptable if that's all you do. But if you're a CEO, we only want 1 additional board, okay, membership other than your own company, because it just takes too time away from your day-to-day activities as a CEO. So, those are just general things, but large institutional investors look at these things. And when they do annual voting, okay, they take this stuff very much into consideration. So if you're a busy director, they might vote against you for a re-election like that, except in rare circumstances, very rare circumstances, but in general. So this is just some of the, type of things. And again, this is the current CMA regulation. When they update their principles, they might, reduce it to 4 or to 3. This is where it is right now, like that. But it's always a good thing to see where other countries' practices are, and the academic studies to see, well, how effective busy directors are, or how ineffective, they can be. How much time are they willing to dedicate, and other things like that. So again, when we teach the class, we look at academic studies that have examined, hundreds of companies, and come up with, good academic results from this. Okay. So again, just more questions. I can come back to this because I just want to move on with time about the different types of sample questions. Let me just address one right here. Okay. This is on the stakeholders' rights. A policy for the company's social responsibility, okay, CSR, corporate social responsibility, was prepared. So we looked on their website or on their annual reports to see, do they have a policy? Okay, now we don't like people or companies that just end of the year ad hoc say, well, we're just going to donate to, some charitable organization like that on an ad hoc basis. It should be a policy, okay, in place. But not just that, there's another question right here. The CSR policy, has it been approved by the Ordinary General Assembly? We want shareholders to have a say so, you put the, have that. So that's a better governance practice, okay? And also we have a question on, well, what is the budget that you have, the appropriation, the fund? And we want, again, a vote on that as well. So all these just are measures that contribute to better corporate governance. Okay, now we're going to talk about the actual index for this year. So here we have the index, okay, in a nutshell, and we're going to dive into it a little bit more in detail. So the cumulative score is a 76.72. So you can say it's a high C, maybe a low B, I needed a little bit more labels here because these other categories are, well, the slowest one right here is stakeholders' rights, okay? The highest one, 81.22, is the board of directors. So it seems that we have, generally speaking, pretty good board processes and compliance with regulations there. We're going to get into it a little bit more. And we can see sensitivity to shareholders' rights and public disclosure and is fairly similar at 79. Okay, here's some more detailed statistics about it. So what we just showed above was the mean. So when we say right here, all listed, we're talking, this is the mean score. And this is the median. So they're fairly close. It's good that the median is higher. Okay, so that means, half of the companies scored above, a 78. And the average was pulled down by maybe too many low performers. And like I said, the board of directors score, again, we see the median a little bit higher than the mean, which again is a good result here. Now, of course, we only weight the low score on stakeholders' rights at 10%. Otherwise, the overall score would have been a little bit lower. Nonetheless, this index, for anybody who is a shareholder, whether domestic or international, remote like that, will find this very useful. Find individual, results or scores like that helpful, and give them, confidence that at least that their concerns as shareholders are being given a good deal of attention to. This is a comparison of 2020 to the prior year, and we can see in almost every category there has been an improvement. Slight improvement, but nonetheless a trending improvement. And then I'm going to show right here, let's look at the mean scores over the past 4 years. And even though we started 6 years ago, but the 4-year from 2017, this is when the CMA upgraded its principles, and so we have a good, consistent level of principles that we are able to compare and track a trend. So in the cumulative score right here, you can see this was 2017, 18, 19, and 20, continuous upward trend in almost all the categories right there. This is, again, very, encouraging. Of course, more can be done, to accelerate this instead of, trending up slowly. So we're going to hopefully try to, increase our activities, reach out to companies, hopefully show them, engage the CMA, the regulator, because some of these things, really engaging the companies is just alone is not enough. It might need some regulatory intervention. Again, so it was just a 1.4% improvement over the prior year. The most pronounced was in public disclosure and transparency, 2.5%. Again, stakeholders category, even though it improved, it's still at an overall subpar level. Here's some examples of some best practices with regard to, let's say, CSR, corporate social responsibility, okay? And this is a stakeholder, category. So without getting into the actual scores, but this is just showing the principles, setting aside, okay, amounts from the company's net profit. In other words, to set up social organizations for the benefit of the company's employees or to assist any such existing establishment. Again, employees are a key stakeholder, employees, customers, the environment, okay? These are some of the key stakeholders. Now, you notice a practice in Germany, for example. Germany has the strongest economy in all of Europe. They have a two-tier board system, but they have a principle called co-determination. Large companies that have 500 or more employees are required to have 1/3 of their board to represent employee interests. Those companies that have 2,000 or more employees, you can think like Mercedes-Benz, Porsche, Volkswagen, but half of their board, their supervisory board, has to have employee representatives. And even with that, their performance is very good, okay? It's the strongest economy over there. In the US, there's calls, for at least having one board member representing employee interest. But it doesn't even have to be at the board. You can have employee participation through other channels like that, through various, committees, workshops, to get their opinions, their participation, give them their due regard. There's all sorts of other things that can be done. But again, because you ask yourself, if a company is its own entity, okay, it's its own legal entity, well, who really cares about the company more, the shareholder or the employee? Who really wants to sustain it and make it live longer? So that's an arguable debate, like that. Now, you could make a case for long-term shareholders, okay, but maybe not the short-term that come in and out and like that. So the due attention, to employees for the purpose of sustainability, for more creativity, harder work like that, is valid and is still always the subject of debate in advanced countries. So they try to cater to stakeholders in many different ways. But I'm just gonna, move quickly for time purposes. We could go on this. So I like graphs because in one nutshell, you can, get a good visual for it. So in 2020, we rated 170 different companies. And this is the shape of the cumulative score. So we can see that the bulk are good performers. They're here to the right. They're between the 60 and the 90 over here. But we do see a high peak right here under the 70, dragging it down. So again, we're going to try to work, with the regulator and see how we can come up with different ideas to move the scores of the lower performers and raise the average overall. Because some of the issues are very easily addressed. okay, while some others take more effort. Board of directors, now look how good this looks like, okay? So we see definitely, the bulk of the performance here in the 90% category, okay? Shareholders' rights, not as good as board, but still somewhat bell-shaped. Okay, public disclosure and transparency, bell-shaped, but a little bit better than shareholders right here, because we see the peaks a little bit more to the right. And stakeholders' rights, we see high peaks on the lower end of performance. So this culture of giving due attention to stakeholders needs to be brought up. Financial versus non-financial sectors. This is just some comparisons. So financial is in red. That means banking and insurance compared to the others. All really very comparable, but we do see a good edge when it comes to the board of directors score for the financials. But when it comes to stakeholders, okay, we see lower performance for financials. This is brought down by insurance companies, unfortunately. They need to do better, a lot better when in addressing their customers. It's a design problem where you have the policyholder at odds with the shareholder. And so it requires definitely more regulatory intervention. So I'm not going to get into specifics right now. So again, I'm going to just move through these quickly. You'll have them available so we can get to our speakers. But this is just showing you a breakdown of the different scores. And so this is public disclosure and transparency. Again, non-financial, financial, right here. Shareholders' rights, stakeholders, non-financial, financial. And, yeah. Okay, so wait, okay. So this is my last slide on this, and I'm just going to just share it. We also look at things at a variable level. So for each variable, we have over 225 different scores. So do you have the board of directors report published in English? It was very low, but in 1 year, now we had compliance. And look, the score for something as easy as just publishing in English, because we're offering our companies for investment to international investors. They want to be able to make an informed decision. Should they invest, buy, hold, like that? So it should be available in English. That was done. Related party transactions happens to be trending lower. Board of directors, governance committees. We don't have enough companies that have a governance committee. So that's one of the reasons that there's a low score there. Even though it's trending upwards, it's still at 11%. So we have, we have nomination committees, and we have compensation committees, but we need governance committees too. So that was the last slide I said I was going to show you, and thank you. Okay. I'm going to introduce our speakers. The first person who's going to speak is Mr. Muhammad Amin. He's in the UK right now. He's joining us by Zoom. He's a chartered accountant, chartered tax advisor, qualified corporate treasurer. Before retirement, he was a tax partner in the PricewaterhouseCoopers practice. He was the UK head of Islamic finance. And he served for 6 years as an elected member of the supervisory board of PwC. He served on its audit and risk committees. He has a mathematics degree from Cambridge. Very experienced person. We're really very, honored to have him speak. So he's going to make about a 20-minute presentation, and then following him is Mr. Saad Al-Azm, and he's a local Saudi financial advisor with a lot of board experience. He worked for the World Bank. He's also a CPA, as an MBA from the US. And he served on audit committees. He's going to give a very interesting presentation. And we're going to leave the Q&A to the panel session, where our third guest speaker will be Mr. Badr Suwailim. He's the CEO of Yanal Finance Company, part of Oryx, the Oryx Group, a Japanese company. And he comes from a strong accounting background and has a lot of board and auditing experience himself. Just a few weeks ago, he gave a lecture here at the university to the students that was very well received, and he gave them inspiring talk about a career in accounting, as well. So again, we're happy to have him, and we're going to start with Mr. Muhammad Amin. So I'll let you take over from here.
Assalamu alaikum, Brother Mashur. Before I start, please can you enable participant screen sharing, at least for me, so that I can share my presentation?
Awais, can you do that?
Assalamu alaikum. I'm going to talk very specifically about corporate governance in the context of the independence of the Board Audit Committee. And this is a brief overview of my short presentation. Corporate governance is something which often comes over as very abstract, and I believe in talking about it in a way that is as concrete and as real as possible, because it exists to solve or to deal with some fundamental problems which we'll see once we start looking at the ownership structures. But first of all, when you spend 35 years as a professional tax advisor, you're always worried about the risk of litigation. Now, there's no danger of anybody suing me for anything that I might say in this presentation, but there is a different danger, which is attributing my comments to the many organizations that I belong to. So I want to emphasize that I'm speaking in a purely personal capacity. My background in corporate governance comes primarily from my role at PricewaterhouseCoopers, both on the professional side of the table, looking at client audit committees in progress when you're presenting to them, but also I've been on the opposite side of the table at Salford University, at Manchester Training Enterprise Council. And the most interesting one was the 6.5 years I spent as a member of the PricewaterhouseCoopers Supervisory Board. Because a partnership in the United Kingdom like PricewaterhouseCoopers has its own governance challenges. You have 1,000 partners, and they can't run the firm effectively as a committee of 1,000. It would be utterly impossible. You can never keep anything secret. So they elect a senior partner, chairman, and give him enormous management authority, like a president. Sometimes I compare him to a dictator. But once you've given somebody so much power, how do you keep watch over that person? And so what the partners also do is elect 15 ordinary partners from amongst themselves, partners who do not report directly to the senior partner in their internal firm management roles, and they act effectively as if they were independent non-executives of PricewaterhouseCoopers, even though they're not independent at all because they're partners in the firm. I've also seen corporate governance in many voluntary sector organizations that I've been involved with. And I write quite regularly on this and related subjects on my website. So I want to look at some simple ownership structures. Let's start with the most basic. I want you to imagine somebody aged about 18, 19, 20, an adult, but with no financial business background, whose father has just died and left him with the ownership of a very large, successful business. This son is in no position to run that business. He doesn't have the skills, he doesn't have the knowledge, he may not even have the interest, but he doesn't want to sell it to somebody else. What does he do? He has to find somebody who can supervise that business on his behalf. The staff, the executive directors will be running that business, but they have all the possibility of going haywire. Selecting even one non-executive director by itself would not be enough, because you have the risk. How does that single non-executive director, how do you control them? Can you have confidence? So you need to select a group of them. They clearly are all, as non-executive directors, responsible to the owner. And similarly, the auditor, of course, we're used to the auditor being a legal statutory requirement. It's a statutory requirement in the UK. It's a statutory requirement in every jurisdiction that has listed companies. But historically, auditors came about before there were statutory requirements, because it's another way of ensuring that the people who run that company are not misbehaving, because the auditor is an independent third party, and in this case would be appointed by the owner based upon the advice of the non-executive directors. So that is what I would start off with as the basic sort of corporate governance model. And this applies regardless of whether, as in the United Kingdom or Saudi Arabia, you have a unitary board, in which case clearly you want to have more non-executives who are responsible solely to the owner and are not involved in running the business day to day. Then you have executive directors. If you have the German model of a supervisory board, then of course the non-executive directors would be the supervisory board. Moving on now to a situation where you've got more than one remote owner. In this case, I've chosen to have 3, but any other set where you've got a small number of very large shareholders. Again, they've got the same corporate governance challenge, because they're not running the business themselves, and they will appoint the non-executive directors. It's quite common in this situation for them to appoint one non-executive director each, or 2 non-executive directors each, and those non-executives, they're independent of the running company, but they may not be independent of the remote owner at all. For example, where you have a company that is owned by one or several management buyout organizations, private equity firms, they will typically appoint members of staff or third parties to be non-executive directors of the companies that they're investing in. And again, the audited responsibility is fundamentally to the shareholders via the non-executive directors. It starts to become more challenging once you bring in public shareholders, particularly dispersed public shareholders, while still having a single preponderant shareholder. And here I've shown a 55% ownership, but even if that was 40% ownership, if you own 40% of a company and the other 60% of the shares are dispersed, widely held, in practice, you have operational control. That's why everybody talks about Warren Buffett controlling Berkshire Hathaway, even though from memory, his ownership stake is about 37%. And here you now have a second risk. You have the first risk, management misbehavior, which has been present on all of the scenarios we've looked at, whether you had a single owner, whether you had 3 main owners. But now you have a second risk, which is of the 55% owner using his operational control to extract more than 55% of the benefits from this company. For example, by charging excessive fees, although Warren Buffett personally has only ever charged $100,000 a year for being the best investment manager in history, or by trading with a business owned by the owner on non-arm's length terms. And in this scenario, I think preventing two is the most important task of the non-executives, even though they are going to be elected by a vote of the shareholders, and that's the shareholder vote, which is controlled by the 55% owner. And already we can see how this starts to present serious, challenging governance problems. Again, the auditor is there to report to the non-executives on behalf of the shareholders as a whole. But again, the auditor needs to always remember the responsibility that they have to the small public shareholders, even though it is the 55% owner that is in a position to decide whether the auditor is retained or changed. And then a very different kind of governance challenge when all of the shareholders are small public shareholders. And this is a challenge you see most extremely, not actually with listed public companies, but with large mutual organizations. I'm not aware if Saudi Arabia has many large mutuals, but the United Kingdom and many European countries have mutuals. For example, in the United Kingdom, it's quite common for insurance companies traditionally not to be joint stock companies, but to be mutuals where every policyholder has a single vote for electing management and directors, regardless of whether they have a large policy or a small policy. And the fundamental risk in that environment is apathy on behalf of the shareholders who have the voting power. Because when your shareholding is very small, even with a public company, you may own £1,000 worth of shares, you have very little incentive to spend time reading the financial statements, making sure that you vote in every general meeting of shareholders. And there is an enormous risk of dominance by management. And in this situation, it's exceptionally important for the non-executive directors to prevent the environment being dominated by management. And this comes back to issues which we can discuss later on about whether management should have any presence on the audit committee. In my view, they should have no presence whatsoever. Clearly, audit committee meetings will often need to have the CEO and the CFO present for information purposes, but I believe that the only voting members of an audit committee should be the non-executive directors. That was the case, for example, at PricewaterhouseCoopers, where only the supervisory board members were the voting members of the audit committee. That was the same with Salford University, with Manchester Training and Enterprise Council. So these are the different kinds of challenges that I see for corporate governance, depending upon the ownership structure. And that is actually all I want to say in the presentation. I look forward to the discussion later on. So now I will stop screen sharing.
Thank you very much. Very informative. Appreciate your comments, and I think you're correct. We need to have audit committees who are all independent, the members. Let me introduce my good friend Saad Al-Azam to give his presentation right now.
بسم الله الرحمن الرحيم والصلاة والسلام على رسول الله. السلام عليكم ورحمة الله وبركاته. Dear colleagues, dear students, dear board members, I can't see who's attending, but first I would like to start by thanking Al Faisal University and Corporate Governance Center, Dr. Mashhoor Murad, for putting this special importance on the issue of corporate governance. I look forward to our discussion. My presentation will feature the importance of the independence of the Audit Committee. And also I'll be sharing some general observations. Again, some of it, let's consider it imaginary, things that happened for different companies and from discussions that happened in my previous career. So this is only also a personal perspective on matters, does not reflect on the company I work for. I will start by sharing screen, if you allow me.
We can see your slides.
Yes,
Clear.
excellent. Okay. So an audit committee is essentially an oversight committee. Arguably, it's the most important committee. There's tremendous responsibility bestowed on the audit committee, and therefore ensuring its independence, not only in the choice of the independent audit committee member, that's part, but there are several factors that we have to look at, and you can see 5 of them, and I'll try to touch over them slightly in the following 20 minutes, and I'll try to respect the time that is allocated. So the audit committee, they have the responsibility to check that all the accounting estimates, judgments are being properly made, and that internal and external audits are effective, and ensuring the process that it happens. So one of the main duties is to review the term of reference of the audit committee, to check if it exists. If it doesn't exist, is it updated by recent regulations like the CMA corporate governance regulations? The audit committee members should be independent of the organization's management, as my colleague, Mr. Mohammed Amin mentioned, and they should exercise their own judgment, their own opinions, and they should act freely from any conflict of interest. The process is extremely important, and this should be respected. It depends on the size of the company, if they have nomination committees or not. The process should be documented, and after a few slides, I will share with you some things that will talk about the skill sets that have to be in the audit committee member and how it's evaluated. And those are just for example reasons. This is typically, it's a nice diagram. It shows what type of skill sets we should have. It should cover governance expertise, professional or industry skills, personal attributes, and diversity. Diversity is different from countries to countries, but recently countries have been putting emphasis on this issue. And as Dr. Mashhoor Murad mentioned, there's always progress and updates in each country. The following is a matrix. You can develop your own matrix. I just wanted to show what are the things that you should look for and how you evaluate the current level on the board, what is required, and the comments, and then you can grade that. So these are the skills. This depends on the company, maturity, complexity, how many subsidiaries they have, what type of industry they are in. So these are the things that you should look for. So I can divide them into governance issues where there should be the audit committee member have extensive knowledge and experience. You can cover, the second slide shows about industry skills to deliver overall balance of complementary skills. So we look at the skill sets for everybody on the board. And finally, personal attributes and behavior qualities. And this is really very important. And normally we always look, the chairman of the audit committee particularly should be very strong and have excellent leadership skills because he has a big duty bestowed on him. Integrity and ethics, I can't emphasize this a lot, but these are some of the things. If you go through the factors, you will find they apply differently, again, to the company, size, maturity, and complexity of the organization. But these things are always important to this. The last slide talks more about, as I mentioned, diversity, age, gender diversity, cultural diversity. In Saudi Arabia, we have seen the last year a lot of ladies, very qualified professionals who have been appointed as CEOs and as board members. So this is a big change that happened in the last couple of years in Saudi Arabia. The following slides shows an example of how different ratings can happen. So you can talk about core functions, financial reporting. Is it mature? Do we need to upgrade? You assess the level. So you say, for example, 2 members has extensive financial experience. Normally the audit committee should be at least 3 members. So the current membership, we can say it's okay. If risk management is weak, so we put emphasis for the recruitment, and so on and so forth. We go through the important areas. One important area I want to talk about is the cybersecurity threat. Many companies don't pay attention to it. Some have very strong IT department. Others, they don't pay. So this also is a very important area for Audit Committee, especially in the recent changes that's happening worldwide. I would like to emphasize. Something else to look for, culture and ethics. Culture and ethics arguably can play a big role in the Audit Committee, how it functions, starting from the choice of the members, starting of the culture of, not liking to get into difficult conversations, how to express opinions. An example, for example, could be Audit Committee sitting with the CFO in the presence of the CEO and asking the CEO to leave the meeting could be difficult. And it's important that the Audit Committee, for example, talks with the CFO alone and independent, so he has the room to discuss. Also, it's important. So having that conversation with the CEO and how to ask him to leave and explain those things and the education located with this is extremely important. The last point here was Audit Committee budget. I think there are several issues related with the budget. There's first, how much compensation the Audit Committee gets for its members. And this has a direct relation to the level of qualification and the quality of the people you attract. So how do you pay them? By the hour, by a meeting, annual? What is the pay? In many countries, board members or audited committee members, there's insurance. They pay extremely well. I think many audit committee members don't understand or don't appreciate the risk that comes along with their duties. And they think it's just an easy meeting, but actually they have a lot of liabilities. And I think that compensation should go along with that. So that's one attribute when we talk about the budget. The second attribute, I think also, if you are an audit committee member, you should ask for, or if you want to be an audit committee, you should understand and ask, what budget do they have if they want to hire consultants, legal, or require AUPs, like agreed upon procedures, to examine certain things in the financial statements? Do you have budgets? Do you have board support? Or the answer is no budget or low budget. So this also has a great impact on the quality of the information and the quality of the people you attract to the board. So some of the challenges that we see sometimes in the audit committee, that they are over-reliant on one individual only. And that's a problem. So one guy is experienced, others are tagging along. This is a problem. The audit committee don't have sufficient understanding of the organization and the sector. The process of induction is extremely important for audit committee members. And very, very few companies have a system of inducting either board members and audit committee members to have that. And also the lack of secretarial support. So what do we, if you are becoming first-time audit committee, or if you are an audit committee member, but didn't do these steps, it's very important that you request and review corporate governance framework. It's important you set meetings with the audit committee members and key stakeholders like board, executive, com, risk committee. It's important, it's very, very important to read all previous board and audit committee minutes of meetings and resolutions. I don't come across many people who request that. And this is something very important. It gives you the history of the organization. It gives you idea of the previous challenges, previous issues, and can help you in understanding the organizational development and the issues that you are looking at. So highly, highly recommended. And finally, conducting independent meetings with external and internal auditors. So these are examples like what's considered relationships that could impair independence. These are few examples, for example, that have, if an audit committee member has been an officer or employee of the organization during the past couple of years, or have otherwise accepted sizable compensation from the organization. Some of the examples on that sort, an audit committee who has been serving for more than 5 years, or serving for many boards for the same company, and therefore getting sizable compensation. Does that mean he's independent? Even if he's independent, but if you are relying of significant income of your lively income on this company, these are issues to consider, or if a member is immediate family member of such a person. So these are some of the issues that you have to question as an audit committee member sitting and serving. Second one is how to run the audit committee members. So having agendas meeting, the meeting arrangements. I'm not going to go through line by line, but happy to share the presentation with Dr. Mashkoor and whoever is interested. But the main point here on this slide is that you should receive the package minimum a week to 10 days before to give you time, because you have to read the information, digest it. That's one. You need time to communicate with other audit committee members and request prior meetings with or calls or Zoom calls with management to clarify issues. So having the package received one day or just before the meeting and going through it is a big no practice. So organization plays a big role. You don't want to have on the meeting heavy items on the agenda which you didn't have time, and you have to pass resolutions or sign off things that you didn't have time to look at. So extremely important. So it's not only the choice, it's also the process, how things happen, how things are documented. Also, the audit committee members have to have time to talk to the board and go back and forth on major issues. So running an effective audit committee has many challenges. So making sure that there's appropriate arrangements is extremely, extremely important. Recent development, The new upcoming regulations have a huge emphasis on training and ongoing professional developments of board members and board committee members. So either if you consider this as a professional career, you should invest in yourself. Some companies have funds allocated to it. So you have to check their policies. But definitely, if you want to be a board member, audit committee member, you have to invest, you have to update yourself. There's very good courses, executive courses in top universities that offer this. There's some in Dubai Financial Center that offers, the CMA also is offering some courses. So it's very important to get trained and to allocate budget for this professional training. Development, so good practice. We have to also leverage on existing audit, internal legal advisors in the company. And you can use them to conduct workshops for the employees of the company, also for the board members on certain issues, on challenging issues and recent regulations, also to get certifications around non-financial areas, such as governance, risk management, and compliance. One of the most important roles is the appointment of external auditors. Many times it can be done through the CFOs. So this function should be carried by the internal audit committee. And they have to take appropriate steps to ensure the independence and the objectivity of the external auditor. They should challenge the financial reports, and they should understand the risk of management bias inherent within the financial statement and other documents within its remit. We are living in a complex area. There's a lot of new regulation. There is changes in the IFRS and the implementation of IFRS standards. So they should have the budget, the ability to ask the external auditors or other outside consultants to explain recent changes and potential impact when the time comes on their financial statements. Some of the common mistakes of audit committees, failure to fully understand complex accounting concepts, failure to interview sales personnel and how they conduct and their contracts and impact of how they prepare their contracts on revenue recognition, failure to require more intensive or extensive audits prior to certain warning events, failure to hire, fire, and fix compensation of the internal auditor. These are the things, some of these things, like when you find the internal auditor, you should look at the qualification. You should assess it with the size of against the size of the organization and the complexity of its operation. You should see the size of the internal audit department. Can it carry the job? Can it carry the load? When is the last time the policies and procedures were updated? And especially with the changes of the growth in the company and the changing business model of the company and the ERP system. And finally, failure to monitor the law compliance culture within the company. I'll just try to skip fast through some of the points so we are on time. So some of the common mistakes is the CFO facilitating tendering process and obtaining quotations for external audit, external auditors not having direct access to the audit committee, external auditors having financial relationships or other types of association with the organization. These points are relevant, maybe not so much to established public listed companies, but now we have many companies entering the parallel market. A lot of these companies are smaller in size, have less experience, have less budget. So how things are managed are different than, how to say, companies, larger companies who have more resources and better experience and better management in the company. So over the last point is overseeing risk management. So the audit committee has to ensure that appropriate processes are in place to ensure risk management and internal controls are there. So we have to ask questions. The audit committee have an appropriate understanding of the processes in place to identify, evaluate, and monitor the key risk facing the organization. Does the committee understand the organization risk appetite for each material category of risk falling within the committee's remit? This is really, really important. And as the organization gets more complex and have many subsidiaries, it becomes even more important.
I think we've gone over time. Maybe we can address some of these.
Okay. Okay. I will keep some of the things. Fine. So just to finish the slide, if you allow me just 2 minutes. So these are the challenges that we should look. Does the audit committee ensure the organization focus and review the risk management process? As we see, there has been a move into digitization and organization being more exposed. Is your audit committee looking into social media, cybersecurity, and IT issues? And does the audit committee consider the role of internal audit within the organization? These are very, very important issues. So this is a summary and some recommendations for the audit committee members. Thank you, Dr. Mashhour.
Okay. So, thank you very much for your presentation.
I'll stop sharing.
But I'd like to welcome, start the panel session, and we have our two guest speakers via Zoom available. If anybody has any questions, pass it on to Mr. Ois over here, and he can bring it to me. We're going to start with our in-person guest, Mr. Badr Suwaida, who's also an experienced board member and audit committee member himself. One of the standards of independence that we have here is having been away from the company as an executive for 2 years. Now, in the US and the New York Stock Exchange, they require 3 years, okay? So a little bit more distance away. Do you have any opinion on that standard? Would you like to see, do you think 2 years is sufficient, or would you like us to move to like a little bit more distance to have independence?
بسم الله الرحمن الرحيم. صلاة والسلام على سيد المرسلين. First of all, I would like to thank you, Dr. Mashhour, and Faisal University for honoring me with this invitation. It's an honor and pleasure to be here in this prestigious institution, and it has been a pleasure also to be here a couple of weeks ago, as you mentioned. Yes, as per the regulations, 2 years is the limit for not working with the same company where an audit committee member is. I think looking at other countries, it reaches up to 5 years, and 3 years, as you mentioned, in other countries. I think, if I'm not mistaken, Saudi Arabia is one of the lowest with 2 years gap. In general, governance regulations and laws, they progress and they evolve over time. And I believe that Saudi Arabia has come a long way. I think going forward, enhancing the conditions and enhancing the requirements for the independence of the members is definitely for the better of the governance environment in general. And for sure, I would probably recommend to have a longer period, not more than 5 years. I think it will be a little too long. But I don't see it as a critical point. But I think towards the highest, it's probably better.
Now, what about financial expertise? The requirement is only for one of the members, and usually this is at least 3 members in the audit committee, have financial expertise. Do you think more than one or all of them should be if you're going to serve on the audit committee?
That's a very good point. I think it's good to address the financial expertise. One is probably the minimum. I mean, this is absolute minimum, but what I think could be added, maybe an additional financial expert in the committee. However, an expert in the subject matter or in the business sector of the company is also very crucial for the company and for the audit committee performance. Yes, you want to have a financial and audit expertise in the audit committee, but an industry expert, I believe it should be a must. And that should be, if it's combined with the financial expertise, I think that would be a great value to the audit committee, so that they don't make unrealistic decisions, or they don't make, you know, unrealistic recommendations that are not in line with the industry practice or with the segment they are working within.
Okay, and do you like having people who are not board members belong to the audit committee?
I think it's a good governance to have people out of the board. Of course, it's a good governance to have independent members. In our case, only one independent member is mandatory by the law, and I believe, and I think it's a good practice to have all of the audit committee members as independent. One member from the board, I'm talking here from experience, I'm not talking from theoretical or academical, but one independent member who is also a board member, that could be useful to the committee. Usually, this member works as a communication point with the board. He also, or she, eases things between audit committee and the board, eases the communication, and also escalate or highlight some of the audit committee concern to the board at the appropriate level. Sometimes the audit committee may face a challenge of raising an issue or addressing an issue to a certain level of importance, and that is the role of the board member who is also an audit committee member.
That's usually the chairman of the audit committee.
But the chairman is not required to be.
No, it is required to be independent.
Independent, but not necessarily a board member, right?
Yeah, that's true.
Yeah. So
it has to be independent, but
if
not
all of
necessarily
them,
board member.
yeah, if all of them are independent and non-board members, there could be a gap, and that I have seen from practice. One member, even if he's the chairman, that's okay. One member who is also a board member, that would be definitely useful and beneficial to the committee.
Thank you, Mr. Badr. I have a question for Saad. You talked about cybersecurity risk, and this is increasing for a lot of companies. Now, you first thought that naturally, you know, this is also part of mission creep. Like, you signed up to be on the audit committee, and then now this new risk comes. And for companies that don't have like a risk management committee, it normally would just fall under the audit committee, and now you have to address that. So this is like, you know, so now your scope of work has increased. Can you, but if you're working in a bank where you have a risk management committee, do you think cybersecurity risk should belong there with risk management, or should the audit committee undertake that?
Well, this is a very, very important point. Cybersecurity is extremely a sensitive issue. As they say, there's two types of companies. Companies who already been hacked, and companies that they are hacked, but they don't know that they are hacked. So this issue normally should lie with the risk committee, but I think also coordination with the audit committee is important to be updated on what's happening and to ensure that this risk is covered. Many companies or IT departments, they think they have up-to-date standards, but this threat is always evolving and requires continuous investment. So the role of the committee is to ensure of always allocating the proper budget, the proper expertise, and for the systems. Even top companies, government agencies around the world with multi-millions in budgets are continuously hacked. And this is like a national security. And the government here, and they have paid good attention to this, and they have set up bodies and invested a lot of money in the area to spread awareness, to launch programs. They started with Aramco and Aramco supply chain companies, and in an effort to extend this across many companies. But there's a long and a lot of work to be done. So where you place it, mainly risk, but I think also audit should be informed if the company has a risk committee. If it doesn't have, definitely it falls under the audit committee and also on the board as well to follow up and ensure that this issue is addressed. Thank you.
I have a question for Mr. Mohammed. This might be a little off subject, but I know it's something that you can address and help the audience with. In the UK, you know, there's a large Muslim community for, you know, a long time. And you have Sharia compliant mortgages where people, you know, finance their homes in a Sharia compliant or Islamic manner. And the UK has actually accommodated the Muslim community by giving similar tax consideration, tax exemptions, like that they give for conventional loans to by deducting interest payments. They extended that also to Sharia compliant mortgages, which really there's no real interest in there. You know, can you give the audience maybe a little bit of background about, you know, the process of bringing about you know, the secular government legislatures to accommodate these financial instruments that are Sharia compliant?
Certainly, I'd be glad to help. The first principle to appreciate is that the tax law of the United Kingdom developed, like all Western European countries, over a long period of time in an environment where all finance was conventional finance, as we call it. So if you're thinking about purchasing a house, in the United Kingdom, we have a real estate transfer tax called stamp duty land tax. And if you purchase a house, you get charged stamp duty, but you only get charged stamp duty once you bought the house. Even if your purchase of the house is financed by a mortgage, so that legally the house may be registered in the name of the bank until you have paid off your mortgage loan, there's still only one charge to stamp duty land tax. Now come some Muslims who want to carry out a Sharia compliant transaction. And without getting into too many details about Sharia compliant transactions, the basic principle is that the house will change ownership twice. First of all, from the original seller to the financial institution, and then from the financial institution to the end buyer. And because these have to be real sales for Sharia purposes, then logically you have two charges to stamp duty land tax, which means that automatically, even before we consider any other aspect of the tax law, a Sharia compliant mortgage would be much more expensive for the customer than a conventional mortgage where you only pay stamp duty land tax once. So that was the problem that needed to be solved. And you have to solve it in a way which complies with other fundamental principles about the way that the United Kingdom sees its constitution. Because We do not want to have separate tax laws for Muslims and for non-Muslims. We do not want to have religion as part of our tax law. And what was devised was a way of describing transactions where you have party A, party B, party C, and if certain transactions happen, which the people making the law understood very well would only be done by Muslims wanting to do Sharia compliant transactions, because although non-Muslims could do these transactions if they wanted to, there's no reason why they would want to. But when you look at the law never mentions Sharia, it never mentions Islamic finance. It just says, if you do these kinds of transactions, certain things happen. And what happens in this case is that if you do these transactions where there's a sale from the original owner to a financial institution, the financial institution sells on to the end user, and certain numerical rules are complied with, numerical rules that are not written in any way to mention Sharia or Islamic finance requirements, then there is only one charge to stamp duty land tax. So Muslims engaged in Sharia transactions and non-Muslims engaged in conventional mortgages pay exactly the same stamp duty land tax. So that's the approach that the United Kingdom has taken.
Well, thank you very much for that explanation. I have another question. I think maybe you can address it first. This is back with the Audit Committee. Now, the Audit Committee is independent, and they're supposed to make recommendations to the board on certain things like who's the external auditor that they're going to hire and how much they're going to pay them. What if they made a recommendation that the chairman of the board or the rest of the board didn't take that recommendation? I know in the UK you have a comply or explain, and in some other jurisdictions, like I think even here in Saudi Arabia, in this particular case, there's a comply or explain. But from your experience, because I know you've dealt with this over the many years like that, what happens in such a situation?
Well, first of all, in practice, such situations never arise. And the reason is that the board of directors should, in my view, have a majority of non-executive directors. But even in those situations where you don't have a majority of non-executive directors, once the non-executive directors have the audit committee, and the audit committee should be entirely, in the UK, they would always be entirely independent non-executive directors. Once they've given the audit committee the task of interviewing audit firms, receiving presentations, reaching a conclusion, that conclusion goes back to the board. If the board has a majority of non-executive directors, clearly they're going to approve the recommendation of the audit committee. If the board has a majority of management directors, which is still often the case, for the management directors to vote down the recommendation of the independent audit committee about who the company's board should recommend to the shareholders who act for the general meeting, where the shareholders legally vote upon who the director auditor is going to be, it would cause such an outcry, such a total outcry with shareholders, with indeed the government, with external regulators. If we're talking about a financial institution which has external regulators, it would just never happen. The bigger concern I have in practice is that management still often has too much of a voice in the selection process being conducted by the audit committee. So quite often management will be asked by members of the audit committee how they found the audit partner from firm A compared to the audit partner for firm B. And I believe very strongly that management should not even be asked those kinds of questions, that the entire process of changing auditors needs to be kept away from management 100%. The only role of management should be to make themselves available to the external audit firms who are reviewing the company and reviewing its systems to decide how much they want to quote for the fee. But in terms of voice, I believe that management, the CFO, should have no voice at all. In the same way that they should have no voice in the nominations committee, which is the committee that decides to recommend new non-executive directors. So go back to my last structural example, where we had a very large number of small public shareholders with no controlling shareholder. In that situation, of course, the question is, where do new non-executive directors come from? They get chosen by the board nominations committee. The board nominations committee needs to be entirely composed of non-executive directors. And in the process of selecting new recommendations, they need to keep that process well away from management. I had a concrete example of this at Salford University, because while I was on the council of Salford University, the chairman of the council was retiring. He'd done his a number of years. He was no longer going to be independent. He was retiring. And the chief executive of the university, who in the United Kingdom we call the vice chancellor, he offered to help by interviewing potential candidates for the role of new chair of Salford University's council. It was going to be an external appointment. And I said to him quite clearly in public at the full council meeting that, thank you for the offer, but that was the last thing I wanted, because I did not want the new chair of council to feel that they owed their appointment in any way to the chief executive, the vice chancellor. Apart from anything else, the most important role of the chairman of council is to persuade the rest of the council to terminate the CEO if the CEO is unsuitable. So you don't want the chair of the council to feel any sense of responsibility to the CEO. And once I explained that, the vice chancellor fully understood it, and he took no further part in the selection process. It was quite clear that the non-executive independent members of council would not let him take part in the process. That is how strongly you have to think about independence.
Thank you, Muhammad, for that answer. Mr. Badr, along that, what opinion do you have regarding board elections? Do you think it's healthy to continue by having staggered boards where only 3 members are up for election every year and people get 3-year appointments? Or do you think we should move to the trend where the US is moving towards, where you have annual elections for every board every year, even though there's a good chance that they're re-elected again, but they're still under the pressure, you know, that they have to perform every year. Do you have any opinion on this?
I think this goes back to my previous comment about the development and the evolution of the governance environment in the country. And we are coming from a time when there were no independent members at all in the board. And as of now, as you can see, 1/3 of the board is required to be independent, which is a major milestone. Of course, having you know, real and strong independency is something that will also develop over time, because sometimes a member might be independent but does not act independently. Going forward, other countries, as you rightly mentioned, they are already into majority of boards are required to be independent. So this is the way forward. But I think we should not move fast, because suddenly moving from a level to another within you know, the governance environment, it might cause some disturbance to the board operation. So I would suggest that this can be a medium to long-term objective the regulators. But for the time being, I think 1/3 is a good step. If I may comment on your question about cybersecurity, for the financial sector, which is under SAMA regulations, there has been very strong focus and very strong regulations coming out from SAMA for the banking, insurance, and finance sectors. And there, the framework has been established for all these companies, and the reporting line, the way cybersecurity functions is all elaborated in the framework. Even within the risk committee of the company, whether it's a bank, insurance, or finance, there should be one member at least who's a cybersecurity expert. So similar to the previous or the current law of having an expert in finance and an audit in the audit committee, now risk committee must have at least one member who's cybersecurity expert. The cybersecurity function should be independent from IT, and it should report to a controlling or a control department, not an operational department. So there has been a very strong, very good framework coming out from SAMA that elaborates a lot on this. This could be useful also to the non-SAMA publicly listed companies if they see it.
Thank you, Mohammed. Saad, do you have an opinion on staggered boards versus annual elections? What would you like to see?
Well, I agree with my brother Badr. We have to take into consideration the progress and the maturity of the financial markets. Eventually, this is where we want to go, but we have to go there at the pace that is good for the market. You have to invest a lot in training. I think for board members, certifications, budgets for that. I think cumulative voting is extremely important part in voting for election. So where we are now, I think it's suitable. And I believe that the CMA is taking very important steps and always working on improving and adding more good additions to the existing laws to improve the corporate governance in the country. I think we should look also really at Numu, which is going to grow a lot. And those companies have, they're very different, companies. They are smaller, less experienced. And I think a lot of awareness and training should be done to them before they are entered the market. I think this is a very important area. Yes.
In our research and our corporate governance index, we've seen that size matters
yes.
to governance because of budgets, appropriate, to matters.
Absolutely. So
they've been challenged. The ones that come from Numu and just recently moved up to Tadawul, they tend to bring down some of the governance scores like that. So again, those are one of the things that we're gonna discuss with the CMA in our recommendations to them, that it should be an area where they should focus on, and where we think combination of some more training and more education and attention to these governance matters for these smaller companies is going to be very helpful.
Another issue I want to ask you, maybe, how do you see with the expected numbers of companies going into this market to be included in your index? Or are you going to create a different index for them? Or so?
Now we're only looking at Tadawul, but we do have definitely plans and ambitions. I mean, to even look at other markets, GCC markets, and Numu would also be, another one to look at. So, but again, even when they're on Tadawul like that, we usually wait for a company to have 3 years of traction before we include them in our index. It's just the way our model works, that there's certain variables or questions that require 2 to 3 years being in the stock exchange, before we can rate them. So
thank you.
You're welcome. I think we can probably bring this discussion to an end, unless there's maybe 1 or 2 questions we can just take from the audience if somebody has. or we can, move to the, awards phase of our ceremony. Okay, well, you have a question? Okay, sure. They'll bring you a microphone.
I am Ali Benazir. I am the Secretary for Legal and Board Secretary for the Saudi Electricity Company. Actually, I just appreciate what providing for us from your experience, and I have just one comment on to discuss about independence for the Audit Committee. You mentioned the most of audit members report to be independent, but we members from outside the board. A member from outside the board will never consider us independent. There is no described in the CMA regulations for this as independent. The only description for independent will be for the board members. And there is a mandate for the NRC to investigate and check the independency for the board member only, not the committee. So, as you say, the chairman of Audit Committee is the one who supports the committee and take any concern to the board. And yes, he is a board member, independent board member. He's supposed to be. That's the first one. Because the second one, actually, for the number of independent member in the board. The concern was previously we don't have any independent board members. Now, as we said, we have a minimum 2 or 1/3 in the board. But there is a reality nobody will come to it or understand it. That it's impossible in some sector to have independent member because of our supply. We have so many, issues we need to consider because it's difficult. To be honest, we face so many issues and we couldn't find a qualified and independent with requirements. Sorry, CMA requirements.
Yeah, thank you. I mean, obviously that there's always that debate because you can be technically independent, but not really independent, like that, due to other relationships, that aren't, just codified. But like the question we posed to Muhammad Amin when I asked him, you can see in the UK, they're really, really independent. He's never come across, a situation where a recommendation by the audit committee was ever overruled by the board like that. But again, we're going to move in that direction, to come, with those types of standards in order to give investors confidence in the financial statements that are being reported.
Can I comment on that?
Yes, yes.
Just taking your second question first, the real independence, which I mentioned briefly. Yes, there might have been incidents where independency was questioned, and are they really independent members or not? And the way to ensure independency is for the regulators to continue to develop the regulations around independence. In addition, to continue to question the decisions and action taken by independent members. If the independent member knows well that he is responsible for his decisions and he is responsible to maintain his independence at all times, I think by time independent members will perform in a much better way than there might be some cases right now.
Yes, agree.
The first question, I think I'm not an expert in the law, but independency is, yes, I know there is a definition of independency, which is related to the board. So it automatically, I'm just guessing, automatically taken as for the audit committee, because, for example, I am an audit committee member. in organizations where I'm not in the board. I'm also in other organizations, board member and a member of the audit committee or chairman of the audit committee. So in the case where I'm not in the board, I am in the audit committee, I'm considered as independent. But whether considered purely by law or majazan, I'm not sure.
Yeah, if you allow
maybe
me,
you are more,
So you could be actually the chairman of an audit committee without being a board member?
correct. I am currently a chairman of an audit committee and I'm not in the board.
Okay.
I'm also a chairman of another audit committee and I'm a board member. I'm also a member of an audit committee and not a board member. So I have all the
Yeah,
mix.
the rules, they just say the chairman has to be independent and at least one member of the audit committee has to be independent and at least one member has to have financial expertise.
Yes.
And like that. So that's been with us since 2017 and, you know, it's probably going to be due for an upgrade, you know, sometime. So,
if you allow me, I would like to what you said in one example in German, just you said there is one board member represent the employee.
not just one, no, 1/3 of the board or 1/2 of the board.
Okay,
Okay,
for
for a
some-
larger
for
company.
certain, yeah, a large company.
Yeah.
Actually, we have this here. Nobody will focus in labor law. Labor law, actually, with a certain level or certain size of company, okay, they allow, okay, employee to, create employee committee, and their voice will go direct to the chairman, direct to the board, and they have a meeting, minutes of meeting, and they have the ability to go and question the CEO and review all the policy related to the job.
Well, that's also always very helpful. You have to have a voice somehow, like that, you know, like that. Obviously, when you're at the board, you know, then your voice is there in every, you know, major meeting. But, you know, employee participation is, you know, going to score you better, you know, on, it's just better governance because they're a vital stakeholder. One other thing that's important to address, and I think Saad mentioned it like that, is that it used to be, if you're a board member, this was like an honorary thing. It was an easy, cushy job and, you know, prestigious. But now there's a lot of liability and a lot of risk associated with it. I mean, and not just outside, but even here in Saudi Arabia, we've seen the public prosecutor go back 10 years and look at the board 10 years ago because some issue with land or whatever happened, and they're, you know, holding them accountable like that. So it's and that's why when I talk about, well, the staggered board protects board members from being reelected, well, you have to balance that with this new reality that, you know, there is, you know, increased liability. So I'd like to, you know, just bring that out and also bring your perspective. I mean, would you just take any board, you know, that's offered to you in this kind of climate, or would you think twice and make sure that this is a company that doesn't have serious issues with it?
Yeah, that's a very good point. In the past, it was an honorary thing, and you can be, if you're a board member, it's a matter of, you know, attending 4 meetings per year, receiving a compensation, and, you know, enjoying the ride. Right now, things are very different, and it's a very significant liability on board members. And being a board member and a chairman of audit committees and a member of audit committees, I definitely would advise anyone to be extremely careful in accepting invitations to such roles. I definitely do that myself. I don't, you know, consider roles unless I study the organization very well. I study the shareholders. I look at the practice of the company and the behavior of the management and the board. And because, as you rightly mentioned, the liability is huge. And as we have seen in several cases where board members, audit committee members have been questioned So by all means, my advice is not to take this lightly, regardless of the financial compensation, no matter how attractive it is. In fact, if it's too attractive, you should be concerned. So yeah, I agree with you, and this is my advice to anyone who is considering such a role.
Thank you, Badr. Okay, I think I'd like to thank our speakers, Muhammad Amin, Saad Al-Azam, and Badr Suwailam, who's with us for joining us and taking some of their valuable time to share with us and enlighten the audience. And I hope everybody here learned something new and found it informative. And with this, I'd like to, give them a good round of applause and we can move to the award phase of our event this evening.
Thank you, Dr. Bashir. Thank you. Thank you, Badr and Muhammad.
Assalamu alaikum wa barakatuh. Good evening, ladies and gentlemen. I'm Lubna Raja from the Corporate Governance Center. We welcome you all to the third International Corporate Governance Conference. Now we will be announcing the Corporate Governance Index top results for the listed companies in the Saudi Stock Exchange, Tadawul for the financial and non-financial companies. We will start now with the top 30 non-financial companies. Abdullah Al-Akim Market Company. Al-Yamama Steel Industries Company. Yeah, some people some representatives are out of Riyadh, so they asked us to send them the certificates by email. Al-Andalus Property Company. Al-Mara'i Company. Jabal Umar Development Company. Jarir Marketing Company. Jazan Energy and Development Company. Lazori Company for Jewelry. I know there's a lady. Middle East Paper Company. Najran Cement Company. Naseed International Trading Company. National Agricultural Development Company, NADEC. I know. Okay. The Sahara International Petrochemicals Company, Sibkin. Pasco Saudi Automotive Services Company. Saudi Basic Industries Corporation, SABIC. Saudi Marketing Company. Saudi Dairy and Foodstuff Company, Sadafco. Sira Group Holding. Tabuk Cement Company. And United Wire Factories Company. Now these companies were congratulations. Khalij Training and Education Company. Arabian Cement Company. Fideli Holding Group Company. Saudi Airlines Catering Company. Saudi Electricity Company. Saudi Ground Services Company. Saudi Telecom Company, STC. Sabola Group. Tequeen Advanced Industries Company. And Smith & Yamaha. Arrajhi Company for Cooperative Insurance. Capital Arrajhi. Asij, Elite Cooperative Insurance Group. Arabian Shield Cooperative Insurance. Bank Al Jazeera. Tuba Arabia for Cooperative Insurance Company. Gulf Union Al Ahliya Cooperative Insurance. Malad Cooperative Insurance Company. The Saudi British Bank, SAB. Okay, the Company for Cooperative Insurance, Ta'awniya. Wala Cooperative Insurance. And now with the top 5 financial companies, congratulations. Al Ahli Takaful Company. Al Jazeera Takaful Ta'awuni Company. Bank Saudi Faransi. Saudi Investment Bank, Bank Saudi Al-Istiqlal. Last but not least, Mid-Gulf, the Mediterranean and Gulf Insurance and Reinsurance Company. May the top 5 financial sector and the top 10 from the non-financial come for a group photo. The top with the last trophy. Yeah.
Last
Thank you.